Good afternoon, everyone. Hope everyone's having a great Friday. Thank you for joining us today for the proactive tax planning seminar that we're going to be having, and we're going to do ongoing. So thanks for kicking this off with us right after tax season. My name's Blake Shaper with Brookhaven Tax and Accounting Professionals. I'm a CPA, and I'm joined today by Lisa Davis, another CPA on the team. Thanks for joining us, Lisa.
Hey, Blake, glad to be here.
So I'm going to share my screen here in a second, and we're going to kick it right off. I know we've got some folks still joining, but we want to respect everyone's time. And Lisa will tell you, as many of you may know, we could spend all day talking about just a few of the things that we're going to mention. And I get excited about it. I know Lisa does too. And we could burn 3-4 hours talking about one thing. Of course, we're not going to do that today. We're going to focus really on the high level planning considerations and concepts, some of these things that you may have heard before, and then others may be new to you. We're going to touch on them really at a 30,000 foot point of view, and then we'll have more tailored videos going forward. And if any of these things seem applicable to you based off of your 2023 goals and objectives, we can even have individual calls to where we go through very specific considerations with each of these things that seem relevant to your plan. I'm going to share my screen, and we're going to jump right into it. Thanks again for everyone joining. Give me 1 second here. Okay. Lisa, can you see the PowerPoint that's pulled up?
I can, Blake.
Awesome. So here's kind of an agenda for what we're going to cover today. We're going to try to keep it at an hour or less. And that's going to be a little difficult, but we're going to stay high level on a lot of these items. We'll dive into a few things at a nuanced level, but we're really going to try to stay, like I said, at that 30,000 foot point of view. We're going to talk about tax law updates. This is important. So staying ahead of what's coming down the pipeline and keeping our eyes on the horizon so that we understand what landscape changes may happen is an important consideration in being proactive with any tax plan. We don't want to wait until things change from a legislative standpoint and then scramble to try to make changes to a plan or implement some strategy retroactively. And sometimes you just can't avoid that because legislation. All right, can y'all hear me?
Yes.
Dang technology. I'm sorry. Where did I cut out, Lisa?
Pretty much still going down the list of the topics for today.
Okay. Well, I was sitting there talking to myself, y'all, for probably about 2 or 3 minutes, which is great. I actually was like, Lisa, what do you think on that? And it was completely silent. So I hit on tax law updates. And yeah, I'm sorry.
I did make an announcement that we lost you. So hopefully everybody was in the same boat I was in.
Yeah. I'm just sitting in this room, just chatting with myself.
Well, that's not unusual, but welcome back.
So did I talk about capital gain with y'all, or was that just with me, Lisa? Did I get through that part?
I think you had just moved into it, Blake, so I'd kind of restart right there.
So, and I'll just jump through these and we'll get going. Capital gain tax planning and critical consideration if you plan on selling anything in 2023 that's appreciated in any manner. So what do you set up prior to that? What plan is put in place so that you can either eliminate, mitigate, or defer what you pay Uncle Sam legally in taxes just by having the right thing set up? We're going to talk about that and determine whether or not that's something applicable to you. We'll dovetail into charitable planning. We're going to talk about high level stuff like, what is a nonprofit, a foundation versus a public charity? What are some type of charitable trusts? And this might not be an area that interests you, but it is an area that I know interests a lot of folks, not just from a tax planning standpoint, but as something that they want to be involved in and maybe have their family involved in over the long term. So we'll talk about charitable planning very briefly. Buying and selling a business. This is something, Lisa, that we've got a lot of questions on just from various clients on considerations around acquiring or disposing of a business. And there's so many, both tax and non-tax considerations. Of course, we want to pay attention to capital gain if you're selling a business and some of these structures that can be put into place there to mitigate that. But beyond the tax side, we also need to look at just the basic deal structure. how to protect yourself, and how to integrate into what a legal team would assist with in drafting those deal terms and making sure that what you acquire or dispose of is kept very private, it's protected, and aligned to your goals and objectives. So business stuff we'll focus on very briefly. Real estate considerations, we'll hit on a few things there just to pay attention to that really make a big difference on the tax side. And then we're going to talk about this 2026 sunset. And that'll make more sense as we get towards the tail end of the presentation. But the bottom line is we know certain tax law is going to be changing in 2026, and we need to be prepared for it. It won't affect everyone, but it will affect some folks fairly drastically when you look at estate planning considerations. So anything to add to that, Lisa, as far as topics go? We'll go one by one here. Anything to mention before we kick this off?
No, I say let's dive into the tax law updates.
Perfect. So before I switch to the next slide, I just want to make one general philosophical point here that I want everyone to take to heart as passionately as we do. Most tax preparers focus on preparing tax returns and not doing anything proactively. Most of y'all have heard me say before that the key to an effective tax plan is getting ahead of year-end deadlines and focusing on things like what's on the screen now so you can put the right things in place and mitigate what you pay in taxes proactively. And again, just by paying attention. Tax preparation is nothing more than really a reactive drill to where you're plugging in numbers to documents that are sent to Uncle Sam, right? There's nothing really special about that. It's important that it's correct and accurate and compliant, but what's special is getting ahead of the number crunching and putting in the right strategy based off of your goals and objectives. So let's jump right into what Lisa had mentioned there, the tax law updates. And we're going to hit just on a couple things and then move on to the planning considerations. So what's coming down the pipeline potentially on the tax law side? Actually, there's not a ton being discussed right now on legislative changes. There are a few tax policy considerations that have been brought up that have bipartisan support surrounding the child tax credit, R&D credits, and low-income housing credits. Nothing that's official yet, but the idea there is to preserve a lot of the child tax credit legislation that was in effect during COVID as a form of economic relief for taxpayers. There's some R&D considerations, which is really just more for businesses on how they can depreciate that expense in year one rather than over 15 years, which is the current law. Nothing there that has gained tremendous traction. There is one thing that may be an impact to you, and that's the SALT cap limitation that some senators out or representatives out of New York are trying to modify to be more favorable to taxpayers. So Lisa, can you explain what SALT is and kind of how that plays into what someone might pay in taxes?
Absolutely. And I wanted this one included because it did impact a fair number of our folks who are still itemizing their deductions. SALT stands for state and local taxes. And right now, the combination of the state tax that you pay, excuse me, I'm having some voice issues today, of course. The state taxes you pay are withheld with your paycheck are in this category. Real estate taxes on your house are in this category. And unfortunately, right now, that category caps out at $10,000. And so that does catch a lot of our clients who are itemizing. And so this would be really beneficial if that cap is raised.
And that cap didn't exist before 2017, as you are aware, Lisa. It was really enacted as part of the Tax Cuts and Jobs Act. So there's some conversation right now about either upping that cap or getting rid of it completely, which, like Lisa said, for folks that are itemizing their deductions now or going forward, will have some benefit there just from a tax deductibility standpoint. Other than that, we're going to talk about two other minor things on the tax front, but nothing substantial. The big thing is that bottom part, Lisa. We've heard this from, back in December 22, where, there was legislation pushed out that essentially said that the IRS is going to get about $80 billion over the next 10 years. And their plan was to hire about 87,000 more agents. And that came out kind of out of the blue. It's one of those things that they had talked about, but that large of a number was like, whoa, it's a big number and a big commitment of Congress to fund. There was some pushback though in January, right? So the representatives really pushed back, specifically the Republican Party, and really questioning the 80 billion at large and how it was going to be spent and the transparency. So although the plan is still that the IRS will get money, the amount is a bit in talks right now as to what it would be. And folks have gone so far. You and I were talking about this earlier, Lisa. Some actually Republicans in Georgia, where we're from, have gone so as far to say that they want to abolish the IRS completely. And although we don't think that that's probably going to happen, it kind of shows you the two extremes of what's being discussed right now. You got some folks wanting to give $80 billion to the IRS to ramp up their agents, modernize technology, and then you got other folks that want to abolish it. So my guess is it'll meet somewhere in the middle. What's your thoughts there, Lisa?
I would agree with that. It's almost, there's a really bad TV commercial locally about a strong arm. And so there's one side that wants to strong arm them, and then the abolish side. And as the senior citizen on our team, this debate about abolishing the IRS has been around for a long time. And I think it's just going to continue to be a debate.
It's literally come up.
I think they will
every
find
year.
some middle ground.
Yep. I agree. And it's come up every year since 1999. A lot of
Right.
folks just don't know that. Someone suggests getting rid of the IRS has never made it to Congress floor for voting. What does this mean for you, though? It means that there is likely going to be an increase in audit rates for high net worth individuals, high income earners, folks that are in certain areas from an investment standpoint that maybe the IRS is questioning, things like cryptocurrency, which a lot of folks are in these days. So we just need to keep that in the back of our mind, that funding means that audits will likely become more prevalent. And we just need to be, considerate of that moving forward. Moving on from tax law updates, and that's something we'll continue to talk about. Let's talk about capital gain. So most everyone knows, I think, what a capital gain is, but let's just start with defining it. Lisa, do you mind, before I dive into more of the planning tools to mitigate capital gain, if you can just define it for us so folks know whether or not it's applicable to them?
Sure. Basically, a capital gain occurs when you sell an investment asset at a selling price that's greater than what we term your adjusted basis. An adjusted basis is nothing more than the cost of the asset minus accumulated depreciation, if that is applicable to that asset. So that's a very simplistic definition.
Now, the big thing we find is that people will rush to sell something because they think the market's right. I got to take an opportunity to sell right now. Or they just don't think about the consequences of not considering the planning before they sell. So rule number one is you've really got to plan out what you're doing to mitigate taxes, if anything, prior to selling it. Because once you sell whatever asset it is, like Lisa was alluding to, you personally recognize the gain. And a lot of the things that we're going to discuss on this next slide, these planning tools, they go out the window. The IRS just says, hey, you recognize that gain and you can't do anything with it from that point going forward other than pay the taxes or do a few things that are just more limiting. So rule number one, we can't stress this enough. If you're going to have a large capital gain in 2023 or any year, let's make sure that we do a huddle proactively before you sign any agreement and make sure that the things are in place that you agree with in order to mitigate what you pay in taxes. Anything to add to that, Lisa?
The only other thing I would add, Blake, is even if you're going to have a capital loss, we need to be aware of that so that we can plan as well. So, are there ways we can use that loss to offset something else you might not have been considered selling? So,
Exactly.
Certainly the gains are the more painful, but I think it's important to plan on both sides of the fence.
It's a really good point. And what's on the screen now is not a comprehensive list. It's really just a short list of things that we will talk about if there is a substantial capital gain that you are likely to recognize. And we're not going to go through each and every one of these in a lot of nuanced detail because we'd spend the entire day and only get halfway through the list. We have and continue to build out a library of educational material on all of these items and others that are really just considerations. And I think the important thing to understand is that if you're going to get a tax benefit through something that's on the screen or even things that aren't on the screen currently, there's usually some give and take with the IRS. There's some strings attached. There's rules you have to follow. And sometimes the rules don't outweigh or the benefit don't outweigh the rules, the drawbacks, if you will, which is why you've got to really consider each and every one of the options and weigh it against your goals and objectives. Because you might find that, hey, that sounds like a great thing, not paying taxes with this particular strategy, but I'm not really wanting to do what that strategy requires. So maybe I'll just end up paying the tax. And sometimes that's the right decision. There's a phrase in our community is you don't want the tax tail to wag the dog. And that's really the idea that you don't want this idea of tax savings to really influence overly your larger plan. Of course, it's a consideration. Of course, it's important, but we really want to start with what your goals and objectives are and then see if we can align a tax strategy with those goals and objectives based off of, like I said, the requirements and rules of each of the things on the screen and others that we'll consider. So we're going to go through these. This is probably the slide we'll spend the most time on, but we're still going to keep it really high level. And we're really just going to talk about what are these things so that you all can make an informed decision, not on whether it's something that you want to put into place, that'd be too premature, but if it's something you want to consider. And that's where we'll go down more tailored conversations on those things that may be applicable to you. So again, we're talking about disposition of an asset. There's a capital gain, 1031. Can you talk a little bit about that, Lisa? I know that's changed since 2017. Before then, you could do 1031s on a lot of different things. And now it's really just real estate for the most part. Can you talk about just what a 1031 is and the benefits it provides, Lisa?
Basically, I think the key words for 1031 are the words like kind. You're going to identify a replacement property in a certain time frame. And so basically, real simplistically, you're going to exchange the two properties and defer the tax on your original property. So that's a very simplistic way of describing it. But there are some timetable restrictions, and obviously you have to be prepared to identify the replacement property or the exchange property.
And I think that's probably one of the more constricting things with this strategy, as you mentioned, Lisa, is that those timetables are very rigid. You've got this 180-day timetable, which is kind of the totality of the timeline from when you sell to when you have to be completed with the 1031. But then you've got these intermittent deadlines that you have to meet in identifying that replacement property, executing on agreements and things like that in order to keep this structure and strategy compliant. And you have to do so through a third party so that you don't actually receive any of the funds and the IRS can't say that they're taxable to you. I'm not trying to say it's too cumbersome to the point to where you shouldn't consider it. It is a consideration, though, that this process and 1031s come with very unique considerations from an execution standpoint. But like Lisa said, it's really just the rolling of gain into the next property. And you're deferring it. That's the word that the IRS uses. Eventually, you'll pay tax on that gain when you sell the property that you rolled it into and you don't do another 1031. So that you'll recognize it in the future. You are deferring that gain. The exception to that rule would be if you passed away with the 1031 property in your estate or within trust sometimes, and you get a step up in basis under 1014 of the Internal Revenue Code. In that case, it might not ever be taxed. It passes down to your beneficiaries at fair market value with no capital gain tax. So that's more the long-term play, though. But this 1031 idea has been around for what, decades and decades, Lisa? This is nothing new, but it is a consideration. But I think that the main point there is you got to know what you're doing and have everything lined up before you sign anything, because you're starting the clock when you execute the sale agreement. And you really need to be aware of the requirements even after you sell and roll into a 1031 and what that looks like going forward if you plan on rolling to more and more real estate. Anything you want to add to that, Lisa?
No, I think it's obviously just critical that you're aware of the key dates if you decide to go, choose this vehicle. So,
yep. And again, only real estate. So if
Right.
you're selling
Correct.
stocks and bonds or,
Yeah.
not real property, crypto or whatever it may be that's non-real estate, you can't roll any of that capital gain. So again, this is exclusive to real estate. Rental property counts, and it works there. And that's largely because they changed the law back in 2017, like I mentioned earlier. It used to be that you could do it for airplanes. Like you do it for almost anything as long as it was going from an airplane to an airplane. And then they changed the law there. So 1031s are a great option when they marry up well with the timeline of sale and you want to roll it into something that is like kind real estate. Let's move on to qualified opportunity fund. So this didn't exist, Lisa, and hasn't been around for decades like 1031s, but it's kind of an alternative to a 1031. This didn't come about until the Tax Cuts and Jobs Act of 2017 that I mentioned earlier. It actually created these qualified opportunity. They're called zones, and it's outlined in 1400 Z-1 and 2 of the IRC, and it never had existed before. That were essentially geographic areas across the United States. There's like 8,600 something, I believe. And if you invest in those areas, then you get certain federal tax benefits. And it still works on a 180-day timeline. But the beauty is it can be any capital gain. So where we were talking about 1031s is, hey guys, that only works when you're going real estate to real estate. Qualified opportunity funds work for any gain, stocks, bonds, crypto, real estate as well. And as long as you roll the proceeds of the sale into a fund, either one that's institutional or one that you self-manage within a 180-day timeline, you defer the capital gain. You kick that can down the road until 2027. So it's another unique opportunity to defer capital gain that comes with a level of flexibility as to what you invest in. Like I said, it doesn't have to be real estate, but the caveat there is it has to be in these zones. Anything you want to talk about with these zones, Lisa, these qualified opportunity zones, as far as, what generally makes them up and where you might find them, the type of environments?
Well, I think what I'd like to point out is sometimes I think there's a misnomer about those zones that they're always in, just the, for lack of a better phrase, the worst part of town. And that is not always the case. And, we like to use a city close to us in Greenville, South Carolina, which, is a zone and it's the most robust, renovated area in, 100
It's blowing
miles of
up.
us.
Yeah.
So
Well,
it's
it's a
not
good point.
always what you think it is when you think
Yeah.
about those zones. That's
Well,
always the first thing I encounter with folks.
that's exactly it. And it's important to understand that, although, there's the Greenvilles out there, there's also some really poor economic areas because the spirit of the law that created qualified opportunity zones really was this idea of trying to drive private capital into economically depressed areas and then giving those taxpayers an incentive through a tax benefit in doing so. So there are these requirements to try to put it into these zones. But like Lisa's saying, some of those zones, even though they had to meet certain criteria when they drew the lines back in 2018, they were going off of stale census data. They were going off 2010 census data,
Right.
and a lot of the zones that today are still qualified opportunity zones, like Greenville, maybe weren't the best back in 2010. So you can kind of find the diamond type investments out there. The bottom line is it's a tool. It's not something for everyone. And there are plenty of qualified opportunity zones that you shouldn't invest in just because they're not in a great economy. But if you've got the appropriate investment, which could be buying a business in one of these zones or building condominiums or whatever it might be, starting a business within one of these zones, there's numerous tax benefits as long as you follow the rules that come along with that. And just one of them is capital gain. The idea that you can defer capital gain. The other, and I don't want to get too far into this last one, this other long-term play is if you buy into one of these areas and you hold that interest for at least 10 years, then any of the gain after you sell, let's say it's a business, you bought a business for $1 million and you run it and you drive it up to a valuation of 5 million, you sell it 10 years from now, you don't pay any capital gain tax on that post acquisition gain is what they call it. So ordinarily you put in 1 million, you sell it for 5, like Lisa said earlier, that's a $4 million gain, nothing, which is beautiful. But the caveat there for that particular tax benefit is you got to hold it for 10 years. You got to run that business and own it for 10 years before you sell it. That's Uncle Sam's way of saying, hey, don't just throw money into these areas and then dip out the year after, because that's not really going to help the economy. We want to incentivize you to stay, keep the capital tied up in these areas, and help build the economy. So again, something we can talk about, but the big differentiator here with qualified opportunity funds, unlike 1031s, is you have a lot more flexibility with regard to what you invest in. It does not just have to be real estate. Like I said, it could be starting a business, acquiring a business, building real estate. There are rules that we've got to make sure are followed in order to maintain compliance, but there's a lot of flexibility in the concept and a little bit of limitation jurisdictionally and where you put that money, because like I said, it has to be in a zone. You can go onto Google and find out where these zones exist, qualified opportunity zone map, and there's plenty of them out there, and you can see exactly where they are around you and whether or not any of those economies are interesting to potentially roll some capital gain into. Moving on to charitable trusts, unless you've got anything else on the qualified opportunity zones or funds, Lisa.
No, I think that was a good high level look at those, Blake.
Yep. We're going to try to keep it high level. I'm not going too deep purposefully. So charitable remainder trust. We've talked about trust with a lot of clients at Brookhaven at a very conceptual level. And we say this all the time. We wish there was one trust out there that did everything from a tax standpoint, from a privacy and protection standpoint. It doesn't exist. So you've got all these different flavors of trust. We've got 2 listed up here that come with certain benefits, but also come with certain requirements. And it's because if you did Frankenstein the 2 trusts on the screen and all the other trusts that we could potentially talk about, Frankenstein together into one trust document, they would not be viable from an execution standpoint. They would be in conflict because each trust is trying to optimize a certain benefit. When it comes to charitable remainder trust, these type trusts are trying to optimize tax savings alongside charitable intent. So if you don't have charitable intent, and I'm not saying right now, like you want to give your money to charity, it might be when you pass away. If you know, and you get to decide how much, but if that doesn't entertain you, this probably isn't something for you, but it does entertain a lot of folks. You know, they get to decide how much of their estate maybe goes to their family foundation or some nonprofit that they really are passionate about. And these vehicles are great for putting things into them that are highly appreciated and selling those things within the trust and not recognizing capital gain. Because guess what? These trusts don't pay capital gain. But the caveat to that, and the really important rule, is it has to be the trust selling it, not you personally. So I always tell the story. Lisa's heard this 100 times. We've worked with, you know, folks that have hundreds of millions of dollars, and we'll run into folks sometimes that love this idea and actually had set it up before they even came to work with us. And one particular story, which is kind of a nightmare from a tax standpoint, is they had all this real estate that mom and dad left them. They set up this charitable trust. They never changed the title of the real estate so that it was owned by the charitable trust before they sold it. So they sold it, owning it personally, and then took the cash and dumped it into the charitable trust. That doesn't work because Uncle Sam says, hey, you owned it. You got to pay the taxes on it because you individually recognize the gain. Even though the same day they turned around and poured the money in, again, this was before they were working with us, they didn't mitigate the capital gain tax on a lot of money. So what's important here is that you set it up and you execute it appropriately. And the whole idea is that you got a bucket, you can put things like stocks and bonds and real estate into it. You don't have to sell it right away. It can, you know, be made productive in there. But when it is sold, there's no capital gain. And then that bucket, and this sounds weird, but it turns around and pays you a percentage of what's in it every single year until the term of that trust ends. And usually that's your life. When you pass away, you or even 2 lives, a spouse, let's say, it pays you a percentage. Let's say 5% every year, 10% of what is inside of that bucket from a value standpoint. And then when the second person passes away, or if it's just one life, the first person, that bucket dumps out into one or more nonprofits that you get to choose when you set this up. And it could be your own family foundation, like I mentioned. So a really unique tool that Lisa, I know we've had a lot of folks show interest in these items, and the legal team has helped set these things up. The big takeaway is there's charitable intent here. There's tax efficiency. You're avoiding capital gain. You're also getting a tax deduction because a portion of that is considered a charitable donation. And so it creates a lot of tax efficiency, but there are strings attached to this, and those strings are very important to consider prior to setting this up. Anything you want to add to that, Lisa, on the charitable remainder trust side?
No, I think you did a good job, though, Blake, of pointing out that it doesn't have to be a charity out there that you could set up your own family foundation to be the charity as well.
Exactly. And
So,
we've had a lot of folks set up their own foundations and employ their children, right? So
correct.
they've got a foundation, of course it's registered with the IRS. We help them through that. They're compliant, but they employ their children to do things like manage social media and help out with events. And these clients are usually in their, later retirement years, and they're involving kids, grandkids, and they can even pay those kids and grandkids to be involved part-time or full-time for that matter, as long as they are actually doing work and they're carrying out the charitable intent. And then the beauty is that when they pass away, like I was saying earlier, they might have this trust that dumps out and super funds their family foundation or public charity, which we'll talk about the difference between those two things, but it can come full circle there. So that's high level. Again, we've got more videos, and we're going to do more of these that focus just on the nuances of that trust. We're going to move on though. Installment sales, another tool. Lisa, these have been around forever. This is nothing that's rocket science here. Can you give kind of a very basic definition of what an installment sale is?
Yeah, basically with an installment sale, you're going to get one payment of the proceeds outside of the current year. So for, a simplistic example, if I had a selling price of $100 and I'm going to spread that over 5 years, I have an installment sale. And so what you're really doing is pacing out the income, which is often important, not in my $100 example, but if you had a tremendous sale, just putting it all in a single year could exponentially increase your tax bracket. And so it's a mechanism of controlling the tax bracket you land in, so to speak.
Exactly. A fancy word we call tax arbitrage, which is just playing around with brackets by spreading out that gain, like Lisa was saying, over multiple years. And that's generally customizable, but it's really only for things that you can actually negotiate that, like the sale of property, right? You can't do an installment sale generally like on a stock or bond or
Right.
anything. I guess theoretically you could, but this is generally seen in property type transactions to where you're selling or buying from someone, but really we're talking about selling because we're talking about capital gain, and you're stretching out the timeline over which those proceeds are received. Again, just to mitigate what is recognized each year rather than, everything being recognized in a single year. So there's analysis we'll do to determine whether or not there's a real tax benefit there. Sometimes there's not. Sometimes it doesn't bump you enough into a higher tax bracket to where it's worth it. And then other times, like Lisa said, it can have an exponential impact on what you're paying Uncle Sam if you recognize the totality of the game in year one. Now, the thing with installment sales is it comes with a level of risk, right? If you're going to say that, hey, I'm going to let you buy my property, pay me over 5 years, well, there's default risk there, right? With that buyer, if they miss a payment, and you can have provisions within a purchase agreement that allow you to gain those assets back. So you can
Right.
create some defenses there, but there's still default risk that can period. And a lot of folks don't want to deal with that headache. And that's where deferred sales trust really came into fruition. Like, is there a way to get around that default risk and still avoid the taxes? And DSTs came out as kind of some commodity almost. I mean, these have also been around for a long time, but it's this idea that you still sell the totality of, let's say, the real estate, except you're having a trust sell it, and it holds the money and gives you the money over a period of time. And when you receive it, you recognize the gain. So it's kind of like an installment sale to where you're receiving it out, spreading it out over a period of years, but you're actually selling the asset in year one. So you're not really worrying about default risk with regard to the buyer of that property. The proceeds are going into a trust. They're sitting there and they're distributed over a defined period of time. You generally get to choose, and that creates a level of tax efficiency in almost the same manner as an installment sale. Anything to add to that, Lisa?
No, I think a lot of people would equate installment sales to the old-timey owner financing kind of idea.
Mm-hmm.
And so obviously that does come with the risk you're talking about. And then, the DSTs are a lesser known animal, but I just wanted to throw those terms out there that installment sales, a lot of folks think of those as the owner financing kind of ideas.
That's exactly it. We're going to spend no more than 1 or 2 more minutes on the last two. We'll come back to these in more detail later. 721 exchange is this idea that you can contribute property to a partnership. Instead of selling it, gain equity in that partnership in some manner that a part of that exchange is non-taxable. So think of a piece of real estate that someone wants to buy from you to build a neighborhood on. Well, instead of you selling it to them, recognizing the gain, there might be an opportunity to say, hey, how about I contribute the property to a partnership? I get equity from this partnership. I get 10% or whatever the number is. That's not taxable. That transaction is not taxable under IRC 721. So you can exchange property for ownership, and then you're getting an income benefit over a period of time from the proceeds and income that come from the generation of that property's, productivity, but you're not paying tax on its disposition from a capital gain standpoint. Very, specific scenario where this is applicable, but when it is, it can be extremely powerful. Lastly, depreciation, both 179 depreciation, bonus depreciation. These aren't things that technically are capital gain eliminators, but they're things that you can do outside of the sale of an asset, maybe in a business, let's say, that you've started, and they can eliminate what you pay in capital gain because you're just eliminating your overall tax bill. So I'll give you an example. You sell some appreciated stock, you've got the proceeds, and in that same calendar year through your business, you buy a fixed asset like, I don't know, let's use an airplane. We said that earlier. You buy an airplane and you depreciate the totality of that airplane in year one. So you have now rolled the proceeds of that capital gain into the airplane. You're writing off the totality of the airplane. So you're kind of washing it out so that, you're not paying capital gain tax essentially on what you otherwise would because you deployed that money into an asset that you depreciate. Now, you can't do that with all assets. You can't just roll it into the business, be like, hey, put the money into the business. I don't have to pay taxes. That's not how it works. If you put the money into the business and deploy it into the appropriate asset that allows for accelerated depreciation, like 179 and bonus depreciation, that's where you get into this benefit of washing out the gain that you would otherwise recognize on the sale of that stock or whatever it is. If you roll it into an asset that is not something you can accelerate depreciation, then the IRS says, hey, we'll allow you to depreciate it, but over 15 years or however many. They have tables for this. So you can only depreciate a little bit of that, even though you deployed the totality of it into that asset in that particular year. That's it for this. We'll go into more, but these are some things you can consider if you were disposing of an appreciated asset in 2023. Let's talk about some of these things. There's other things we'll consider as well. Anything before we move on, Lisa?
I was just going to toss out that the 179 is limited to $1,160,000 for 2023. So it's a pretty sizable number. That does have income limitations. You can't take the deduction unless you have income equal to, but the bonus was at 100%. It's now at 80% without those limitations. So if there are assets you're considering acquiring, then we definitely should have this discussion. Really useful tools.
Perfect. Buying, selling a business. We're going to talk about the same capital gain considerations when you're selling a business as we just talked about, because you can put ownership of businesses into trusts and sell them and avoid or mitigate or defer capital gain in a lot of the same manners we just went through. So capital gain is obviously going to be a consideration for the sale of a business, but also deal terms. We're working with a number of clients right now that are selling their businesses, and we're not talking about small businesses. We're talking about, businesses in the, 30, 40, $50 million plus range. And there's specific things within the structuring of the deal that have a tremendous tax impact well beyond capital gain. I've got one example up there, cost segregation. Not going to get into the nuance of that, but imagine this. You're buying a business. You as the buyer, I guess the seller as well, because they have to agree to this, you get to decide how you're allocating the cost of $10 million across all the different things that business owns, right? Everything from its assets to its goodwill in the name and the brand recognition it has to the income stream. Like all of this is itemized out, and how it's itemized can have a tremendous effect in how the selling taxpayer is taxed on the proceeds. Because a lot of buyers, and this is just, of course, an unbalance here of intent, they want to allocate as much of the purchase price to fixed assets. Why? Because of what Lisa just said, bonus depreciation. We were working with someone here not too far away that the buyer was wanting to allocate basically half of the sale price to the equipment in the business when that equipment's 20, 30 years old. Why do they want to do that? So they can write off the totality of that equipment in year one and offset other income that they're making outside of that business. What does that do for the seller though? Well, if they're allocating 50% of the sale price to equipment that seller had previously depreciated, that seller has to recognize depreciation recapture on all of that equipment. And guess what? Depreciation recaptured is taxed at ordinary income rates, not capital gain. So paying attention to allocation and segregation of cost is a huge deal when you're selling and buying a business, because it affects how the seller's taxed and it affects how the buyer is able to write certain things off or not. Entity structure, whether the business is owned in an S Corp or a partnership or a C Corp, comes with its own unique considerations for each of those. And that's an important thing to consider when you're buying a business and also when you're setting a business up, because it not only has tax ramifications, but Lisa and I could talk, in the legal team as well, on all of the non-tax considerations it has on how you exit in the future, how you might give up ownership but maintain control, and how you can allocate in the instance of a partnership between special allocations that allows you to distribute income in a manner that is not necessarily tied to the percentage of ownership that member owns, that partner owns. You can't do that with things like an S Corp or C Corp. If you own 10% of an S Corp, you're getting 10% of the income or loss, period. If you own 10% of a partnership, well, that's determined based off the partnership agreement, and you could receive more or less based off of the deal structure. A lot of times it's still just pro rata, but there's that flexibility there, which is unique from a tax planning standpoint. Tax credits. We've had folks sell their business or buy a business and realize, I'll give an example. Someone bought a business, applied for tax credits for that business from previous years, and got back almost the amount they bought the business for. Wild. That doesn't always happen, but that situation is just, could have easily been overlooked, and clearly was by the folks selling the business. It wasn't until after the business was bought, actually like a year in, that this was recognized. But making sure that there aren't any tax credits available before you dispose of a business or upon buying a business that might help offset the purchase price to a degree or enhance the sale price. And then maximizing long-term tax efficiency kind of goes back to the qualified opportunity zone I was talking about and some other considerations. If you can put the business in the right spot, grow it, and hold it for a long enough time, you might not have to pay capital gain tax when you sell it after a period of time. So all these things are things that we would talk about if you're looking at selling or buying a business in 2023. Same thing going forward. In a year going forward, if you're looking at buying or selling a business, let's talk about these things ahead of you signing anything, because there's some tremendous efficiency that can generally be built into things like deal structuring that will not only help on the tax side, but will help in other areas from an entity structure standpoint as well. Lisa, anything to add to that?
The only thing, Blake, I think that you said that is critical is, talk to us first. once the line has been signed on, we're in the rear view mirror instead of looking ahead. So
Yes, ma'am. Real estate, we're going to hit on this, and there's actually only one more slide. We got 13 minutes to hit our 1 hour goal here. So real estate, entity structuring, like I said before, is critically important. You don't generally want to own real estate personally for various reasons. And a lot of those would be discussed with the legal team if you were setting up an entity to own them. But you want to hold it in the right manner, not just for tax reasons, but also protection and privacy and mitigating creditor risk. And then if you're actively involved, and this is something Lisa and I have found, and the other folks on the team, that folks that are actively involved in real estate just aren't aware of, is that if you hit a 750-hour requirement each year in real estate activity, and it doesn't mean you have to be, earmarking every second. You should keep a record, but let's say generally you spend as a part-time job, any activity in real estate, whether it's fixing up a, maintenance house, or rental property that you own, just doing maintenance on it, or bookings, or managing tenants in any way, fashion, or form. And those hours add up to at least 750 hours. You can, at that point, offset any income that business creates, or income outside of that business, even W-2 income, through the depreciation of those assets that you own that would generally be limited because of passive activity loss rules. So why does this all exist? And I know it's a lot to unpack. It exists because doctors and other folks will buy real estate, let's say lakeside real estate or beachside real estate. They'll rent it out and have it done through a management company. And then they'll try to depreciate that real estate against their really high W-2 income. And the IRS says, hey, you can't do that. Those are two totally different things. You can only depreciate your lake house against the income it makes. And a lot of times, let's say this doctor and his family are using the lake house. It's not making a tremendous amount of income. So any depreciation that they would otherwise take, if there weren't this limitation, they can't take. It's a passive activity loss limitation. So it's basically just pushed to the side until they eventually sell the property. Now, if you meet the real estate professional rules, then what the IRS says is, okay, we'll allow you to combine these two things from a tax standpoint as it pertains to depreciation. So now any depreciation from that lake house or beachfront property that would ordinarily be limited can be used to offset income outside of it. So W-2 wages, other business income that flows through, let's say a K-1, can now be offset by depreciation of that property because you are, in the eyes of an IRS, a real estate professional. We'll talk more about that, but it's an important consideration. Cost segregation, we already talked about that. Another important piece. Protection, privacy, we hit on that. Tax incentives, I won't go into a ton of detail here, but we talked about some, right? Qualified opportunity zones. Well, there's also state and even local tax incentives that can be tremendous for real estate opportunities, and you should look into it. I'll give you an example of one just here locally in Hartwell, where I'm from, is if you buy a building downtown in Hartwell and you put money into its improvement, you get 2 state tax credits. You get one for buying the building, which is 25% generally of what you spent over a 5-year period. And then you get 30% of anything you put into improving it. Now, there's some rules with it. You got to employ at least 2 folks within that building, but it could even be rented out to a business. And as long as 2 jobs are created, you get a tax credit, which is way better than a deduction. That's a dollar for dollar reduction in what you pay, in this case, the state of Georgia. So that's unique to not just the state of Georgia, but Hartwell specifically. So it doesn't really help anyone, most anyone on the call. But bottom line is there are state and local tax incentives that can have tremendous benefits in the real estate realm. So something to look into, and we can discuss in more detail there. Anything to add before we wrap this up, Lisa?
No, I think that covered that.
We've got a whole nother video on charitable intent. I'm not going to go through it in nuance here. If you're interested in setting up a nonprofit, let's talk. There are very large differences between a foundation and a public charity, even though they're used almost interchangeably within the nonprofit space. There's very specific distinctions from a tax standpoint and a requirement of how involved you are in a foundation versus a public charity. Very important to understand that before setting anything up. And really getting the family involved is one of the reasons, as I mentioned before, that most families set nonprofits up. It's this legacy type planning of not only creating a tax benefit, but also creating a mission that's charitable, that the kids or grandkids can carry on after your passing. And you don't have to set up things like a charitable trust in order to just do a nonprofit, but it may complement some of the other things that you're looking at setting up or may already have set up, so that when you pass away, that nonprofit continues to be funded in some manner or is funded over the duration of your life and you actively participate in it. So various things we can talk about on that front. We're not going to go too far into the weeds. Last slide before we talk about the sunset, and then we're going to wrap up. Tax loss harvesting, farming, employing kids. These are some areas, Lisa, that you and I and other folks on the team have gotten questions on. And Lisa, can you explain tax loss harvesting and when that is something that's applicable and some of the rules there and limitations?
I think the key takeaway with that is there's a 30-day waiting period. So I think it's important to recognize that you can't just execute and take advantage. Without going into a lot of nuances, Blake, that's what I want everybody to kind of remember about
It's
that
very
one.
important. Yeah.
Yeah.
The whole idea, though, is right. You're selling something purposefully at a loss in order
Loss.
to generate
Correct.
a loss that you can offset other income,
Right.
which makes sense. But like Lisa's saying, you can't just sell an Apple stock and then the next day, sell it at a loss. The next day, buy an Apple stock and be like, hey, I sold it yesterday and realized a $100 loss. No, the IRS says if you're going to do that, if you're going to sell and then go back into a very similar asset, in my example, then you're going to have to wait at least 31 days for that loss to actually count. So tax loss harvesting is important. If you've got positions that are lower than what you paid for them, it's generally something we look at doing in late Q3, early Q4, if it's something that's applicable to you. And we'll just look at opportunities to maybe sell some things to generate loss, to offset some income in other areas. Not applicable to everyone, but the key thing that Lisa said is you can't just roll back into what it is you sold for a loss for a period of time. Otherwise, it'll be disallowed from the IRS standpoint. Farms, another very important thing from a tax standpoint, but also just getting involved in something that a lot of families like to set up. We can talk more about that if that's something that's applicable to you from a goals and objectives standpoint. And then another question we always get is employing the kids through a family business. There's some really unique ways to do that in such a way to where you can pay the kids to be involved in your family business. They've generally at least got to be 14 years of age. That's not an IRS rule. That's a DOL rule, Department of Labor rule, in order to be technically employed. But once they're at least 14, you can actually pay them right off their salary and wages through the business. And then if you keep them under certain marks, they don't even have to file a tax return. And then concurrent to that, because they've got earned income, they can turn around and put a piece of that into an IRA and get what's called the saver's match from the government because they're in a very low income bracket. So very specific things or more general things we can discuss on that front if that's interesting to you. We're going to wrap up with the sunset, as I had mentioned on the first slide. So Lisa, we've got this tax law that's coming down the pipeline. We know it's going to happen unless there's some legislative change in between now and 2026, which does not seem to be on the horizon to change this. So we know in 2026, what they call the unified credit is basically going to be cut in half. And can you describe, what is the unified credit? Who does it generally apply to? And what does this sunset mean for folks from a tax planning standpoint?
In really simplistic terms, the credit is basically a lifetime exemption for your estate and gift tax purposes. And pre-sunset, it's at $12.92 million for this year. But post, it's going to get cut to, they estimate, 6.8. So in terms of looking at giving and in your estate planning, there's a critical distinction between now and 2026, January 1. So
Yep.
it is a really critical time to look at that.
Unified credit's such a weird word, right,
It
Lisa?
is
It's
a very
basically
strange word.
it's a watermark, right? So
Right.
it's the IRS saying, hey, if you die and your net worth is over this watermark, and we're going to decide what that is, and we're going to change it, year to year maybe. But if it's over that watermark, you owe us 40% of everything above that, which is wild. That's to the federal government. So that watermark, like, we want to pay attention to that. It's the highest it's ever been right now
Right.
in the history of tax law because of the Tax Cut and Jobs Act. But in order to get that accelerated unified credit to go through back in 2017, there was some bartering going on between Republicans and Democrats. Republicans were like, hey, we want to up this, which basically means the rich pay less taxes. We want to up it to, it was, I think, 23 million-ish when it started, and it's been indexed ever since, somewhere around there. But the only way they could get it through and get bipartisan agreement was to agree that eventually it would go away. So they had to write it in 2017 that it would sunset in 2026. It would go back to what it was pre-2017 indexed. So it's going to be cut basically in half, which means that, if after 2026 your net worth is over, let's say, roughly $7 million, single $14 million, married, and I'm just using round numbers, it's indexed, then every dollar above that is going to Uncle Sam at a rate of 40%. So we want to stay ahead of that, because you got a lot of folks now that are going to fall into that window that didn't previously fall into that. And considerations on the bottom. We're going to talk about gifting strategies, irrevocable life insurance trust, things that can be implemented to remove assets from your estate proactively, so that when you pass away, Uncle Sam's not looking at them to tax them. Again, something we'll have more detail on, and we will discuss on a case-by-case basis. All right, we're wrapping up now. So what's the next steps here? Really, everyone on the call and webinar needs to really look at what their goals and objectives are for 2023. What are you doing in 2023 that overlaps with anything that we talked about? Selling an asset, buying a business, whatever it may be. That's going to help determine whether or not we need to have a call about planning and what we may talk about. We're going to start doing planning calls in June. Those will last through Q2, Q3, and that's going to be a proactive measure to set the right things up if you so desire. We're going to send out instructions on that, how you sign up for a call and get that ball rolling. And again, the goal here is to proactively set up these strategies no later than end of year, so we have that efficiency built in prior to next year when we're doing tax returns for 2023. Thank y'all so much for joining. We'll continue to do these type webinars from an educational standpoint. We appreciate y'all as clients, and we look forward to the next chat. Thank you so much.
Take care.